Welcome to Dorsey and Whitney's webinar on preparing for the 2024 SEC reporting season. I'd like to introduce Kimberley Anderson, a partner in Dorsey's Corporate Governance and Compliance Group. Kimberley, take it away.
Good morning, everyone. We are delighted that you are taking time to join us for our webinar today for preparing for the 2024 SEC reporting season. I just want to go through a few housekeeping details before we jump in. So first, sign in on the attendance form. The materials and attendance form are available for download from the reminder email sent from events@dorsey.com. Don't forget to return your completed attendance form to attendance@dorsey.com. So Dorsey will be applying for CLE in the jurisdictions listed on the invitation. Now, unfortunately, we have a lot of ground to cover today. Okay, I'm always kind of amused by that because we have a lot of ground to cover every year. It makes it sound like somehow today's unusual. It's not unusual, but we do have a lot of ground to cover today. So if you have a question, you're welcome to contact us directly or reach out to your usual Dorsey contact. We will put links to download the materials and attendance form into the chat along with the CLE code for states that require a code. After today's program, we will send out a survey and appreciate your feedback. This email will include a link to the playback page on dorsey.com and the supplemental materials. So I would like to introduce the speakers. Well, okay, first there's me. My name is Kimberley Anderson. I think my bio indicates that I've been doing this for over 25 years. This is, in fact, I've been doing it for 30 years. So, which does age me, I will be the first to admit. So I've been doing public company reporting, corporate governance, as well as capital raising for clients for a number of years now, and primarily focused on the mining industry. And then my co-speakers, Anthony Epps. So Anthony is in our Denver office. And so Anthony is also in the capital markets group. His practice focuses on corporate governance, securities, transactions, and mergers and acquisition. And he also he advises public companies on reporting and compliance. Well, okay. And I and Anthony all do these things, just so you know, and we're all very good at it. Okay. And they're younger and smarter, but nonetheless, we do all do this work. Cam also helps our clients Cam Hoang is in our Minnesota office, helps clients with, governance, SEC compliance, securities offering, and M&A. She was senior counsel and assistant secretary at General Mills before she came back to Dorsey. So our bios are in the materials, but I think what we'd like to do now is jump in. And so we can get going on today's presentation. There we go. Okay. So briefly, this is our agenda. And yes, it is a long agenda. Cybersecurity, clawback, share repurchases, 10b5-1, risk factors, et cetera. Proxy statement. In brief, we're going to be going through some various changes in proxy statements. Climate change disclosure, if we get to it, we're not going to spend long. The last one, new reporting for resource extraction issuers. We may not get to that today. We will be doing a January 10th webinar on that. So if you are a resource extraction issuer, which means, oil and gas or mining, we will have a separate webinar for some reporting that is now coming into play. All right, so let's jump in for cybersecurity. So the SEC has been talking about cybersecurity really for quite a while. They've been doing it for over a decade. In 2011, they came out with their disclosure guidance topic number 2. It covered, risk factors, MD&A, description of business, legal proceedings, financial statement disclosures. Then they updated that guidance in 2018 for the commission statement and guidance on cybersecurity disclosure. So that came out in 2018. It updated that. One of the things that it was very clear on is that, look, even though Reg SK and Reg SX don't mention cybersecurity, those are things that can be extremely material to companies and must be considered. And companies should, like always consider materiality of their various risks. If something keeps you up at night, then there should be a risk factor. That is that's my general rule of thumb. If the thing that worries you the most about the company is not explicitly mentioned in a risk factor, you need to revise your risk factors. For many companies, cybersecurity is among those. Now, There are new rules that came out, but I want you to understand, particularly the 2018 guidance, it really does still have relevance. But let's go through the new rules. So in July of this year, the SEC finalized proposed rulemaking on risk management, particularly incident reporting. So, it was some of the new guidance and reporting with respect to 10Ks and so on, all became effective very recently or next year in the case of a smaller reporting company. So, but specifically and actually it should say the rules, it requires, current reporting about a material cybersecurity event on a Form 8K. So first, let's walk through what happens. First, we're going to briefly touch on the concept of an 8K, what you have to report, and then we're going to go into your 10K. We're only going to spend a minute on this, but it's worth reviewing. So you have a cybersecurity attack. First things first, you're talking to your IT people. They're going to be talking to the potential third-party experts to figure out what is happening. Your executive team is informed, and soon, but it won't be the first thing, you're going to call your security lawyer. And you're going to say, do we have something we need to report? First things first is you have to decide if something was material. So, and I know your first thought is going to be like, we just don't know. We don't know if it's material yet. We don't know if this has impacted us. We don't know how big it is. It's like, well, and then you can't say to yourself, well, we'll know by the end of the quarter. It's like, no, that's not good enough. You really need to determine materiality without unreasonable delay. So in other words, if you believe it may be material, it will be prudent to report it on an 8K. So you don't need to disclose everything, but really sort of the nature, scope, and timing, and the material impact or the reasonably likely material impact on the company, including its financial condition and results of operation. So in other words, you don't need to have all the answers, but you do need to indicate what would be reasonably likely. And actually, for clients that have had, unfortunately, gone through a cybersecurity attack, sometimes these disclosures are actually these rules, especially with the 8K. It does provide specific guidance about what people are expecting to see. It gives you a bit more of a sense of, what do we need to do? For a foreign issuer, since they don't file Form 8Ks, it would be a 6K, which has now been amended to specifically identify a cybersecurity attack as a type of material disclosure, because otherwise it might not necessarily trigger. Okay, all right, so now we're going to go on to annual reports. So upcoming annual reports on either a Form 20F or an 8K are going to be requiring new disclosures. So, and depending on the form, it will be located in different areas. So for a 10K, it will be a new item 1C, cybersecurity, which is in part 1 of Form 10K. For 20F, it will be new item 16K, cybersecurity. All the new disclosure on 20Fs always gets thrown under 16, which is why we're now up to K on 16. So essentially, what's going to be discussed here are really two components. One is risk management strategy, and the other is governance. So you're going to be describing, any processes, like we said, for identifying or managing material risks. So, have you adopted, so it says whether and how many processes have been integrated into your risk management. Great. So do you have, for example, have you adopted an overall enterprise risk management? Are any of these policies and standards based on there are different approaches and frameworks that are out there? Have you identified and are using any of those? Have you identified and have you engaged third parties in connection with these processes? In other words, if you're in the midst of evaluating your cybersecurity risks and so on, and so you have third parties there, like have you engaged third parties? Do you have the process in place to actually oversee these third parties to ensure, to identify those risks? So, and then you also have to indicate if there's been any risk from cybersecurity threats that have materially affected the company. It's like, have these impacted your strategy, the results of your operations, and so on. Then we go into governance. So with respect to management's role in implementing cybersecurity policies and procedures. These rules have been scaled back from the proposed rules. The proposed rules were requiring much more in terms of, gee, do you have cybersecurity expertise on your board? Now where it really focuses, there's more of a focus on management. In other words, who is, what management positions or their committees responsible for assessing these risks? What is the relevant expertise? And then, what are, how will you be able to identify what committees are informed? How do you monitor the prevention? In other words, what they're looking for here is a discussion of how management and what is management's role in both trying to identify these risks as well as the processes to help mitigate these risks, and who's responsible for it, et cetera. So do these people report to the board? Are they reporting to a subcommittee of the board? How is the board, what is the board's oversight of cybersecurity risks? So essentially what it really comes down to is that you do want to make sure that you have cybersecurity policies in place. The last thing you want to do is try to pull in some boilerplate at the last minute saying, yeah, we have processes, or we're developing processes, or something. But you really want to put some thought into this, because this is something that the SEC considers to be very important, and so do investors. So think about your policies, think about the reporting chains, and the assessments you make. What board, is it going to be a full board? Are you going to have committee oversight roles, et cetera? So these are things that you just want to think about, because this is some of the new reporting that people will be focusing on. And now I'm going to be turning it over. We're going to be discussing clawback policies.
Perfect. Thank you, Kimberly, for setting the stage up for us on cybersecurity. So today I'm going to be talking about clawback policies, but specifically just best practices and clawback policies. I mean, specifically, I think a lot of issuers have been concerned about clawbacks and clawback policies, mostly because the New York Stock Exchange and NASDAQ adopted listing rules requiring listed companies to adopt clawback policies. So clawback policies in and of themselves aren't anything new. It's just more of now you've got the New York Stock Exchange and NASDAQ mandating it. So the first things first is that you had until December 1st to adopt a clawback policy. I know I wish that we could have had this programming a little bit, but before that time, but December 1st was a deadline to adopt a clawback policy under NYSE and NASDAQ's rules, and then of course Rule 10D1. So specifically with the clawback policies, that the key takeaways are that, like we talked about in last year's presentation, that it's triggered by both material accounting errors. So we're talking big R, little r restatements. There's not a fault component to it. So it doesn't really matter if the company or the individual was actually responsible for the restatement. We've had situations where sometimes you can change accountants and one.
Oh, Anthony, I think you're on mute.
Oh, excuse me. So essentially with what we're talking about now are our clawback policy best practices. So essentially the big takeaway from this is that on December 1st, we had our December 1st deadline. Mostly the big thing for clawbacks this year is that the New York Stock Exchange and NASDAQ have adopted rules which make it such that if you don't have clawback policies adopted but by December 1st, then you may get a notice from them that you need to do it. As we've talked about in previous years, it's triggered by big R and little r restatements. And then also that there's not a knowledge component or a fault component, and it's going to cover current and former executive officers. The big takeaway, though, from this is that it really deals with financial metrics So compensation that deals with financial performance, such as share price, EBITDA. So to the extent that your compensation practices don't have any sort of financial metric, then the clawback policy probably won't apply to the individuals. And so best practices are consider adopting bad acts policies in addition to your clawback policies. So we've seen a lot of issuers this year have combined policies where they have what we call an SEC and NYSE and NASDAQ compliant policies. But then they say, well, look, we've also have other individuals and other things that we want to cover that aren't necessarily accounting restatement basis on what we want to do. So what we've been advising clients is, to the extent it's applicable or advantageous to your organization, rather than have the clawback cover a lot of different things in one policy, you should actually break it up into two policies. So have an SEC one that just speaks to accounting restatements, and to the extent you want to cover other things, have that in a separate policy, and then definitely amend your compensation and indemnification agreements to support the enforcement of the clawback policies or the bad act policies. So let's go to the next slide. So mentioned earlier about a lot of the big kind of concerns about clawback policies this year is that now that the New York Stock Exchange and NASDAQ have put forth listing rules about what you have to do, naturally that they want to be notified. But here's where it gets a little bit tricky, is that they both have different ways to go about notifying them. So NYSE requires you to notice them that you've adopted a clawback policy through their listing manager portal, but you have to do that by December 31st of this year. So to the extent you haven't done that, make sure you do that. But with NASDAQ doesn't require formal notice. NASDAQ just requires that you basically have your clawback policy attached to your next 10K, whenever that is. So if you're looking on their notifications list on items that you have to notify them on, clawback policies is not, but don't worry, that's an intentional decision on their part. Next thing, like I talked about, we got to file the clawback policy. So that's why NASDAQ's not concerned with the formal notice, is because you're going to have to file it with your next 10K, 20F, 40F, or any other kind of form as applicable. But then there's also a clawback policy checkbox on the cover. So of those forms, so make sure you check that as appropriate, and then just disclose how the policy was applied in the last fiscal year and your proxy or other related disclosure. So let's go to the next slide. So now that we've talked about what one of our big ticket items this year was clawback policies, now we're going to talk about share repurchases. And what's interesting is that last year we did a lot of discussion about what the share repurchase disclosure would need to be. That the SEC put out rules, but late breaking news is that the U.S. Chamber of Commerce and others sued the SEC on their share repurchase disclosure rules, basically arguing that the SEC arbitrarily and capriciously did it because they didn't do their proper cost benefit analysis. And so what the SEC did was, when this was filed in the Fifth Circuit, that they requested that the Fifth Circuit give them time to kind of amend the rules and kind of bring something forward. So they requested an extension. The Fifth Circuit denied that extension. And so where we are today is that we expect that the Fifth Circuit to vacate the rules absent an SEC fix. And as of last week, the U.S. Chamber of Commerce and others actually asked the Fifth Circuit to just go ahead and vacate the share repurchase disclosure rules. And the SEC didn't respond to that. So there's a good chance that the rules that we talked about last year about share repurchases, with specifically the disclosure piece of it, isn't going to happen. So it's probably going to be vacated. So what issuers need to do now is issuers need to continue to comply with the existing share repurchase disclosure rules. So continue to comply with that. And it doesn't nullify the rule related to issuers disclosing 10b5-1 plans that was not impacted but by the Fifth Circuit, and wherever that ends up, that particular part is not impacted. So let's go to the next slide. So just like I mentioned, the quarterly 10b5-1 disclosure rules was not impacted by the Fifth Circuit's decision to not grant the extension, and if the rule gets vacated, that doesn't really apply to the 10b5-1 plan disclosure. So like we talked about last year, we've got to have quarterly disclosure of director and officer adoptions, modifications, and terminations of 10b5-1 plans. Essentially, 10b5-1 plans are plans which will allow insiders to buy and sell securities. It's not 10b5-1 is a safe harbor, so it doesn't prevent you from being sued if someone accuses you of insider trading. It's more of an affirmative defense, and then the courts will look at whether the plan was properly adopted, and if there were different amendments and different things that happened that blew up the safe harbor. But with the quarterly disclosure, there's no need to disclose just regular plan expirations or completions. A lot of times 10b5-1 plans have life cycles to them, whether it be on a year-to-year basis or a several-year window. When those plans just go away by their terms, we don't need to disclose in the quarterly disclosure. However, though, we will need to disclose any sort of adoptions, modifications, or terminations. So to the extent that you have insiders who have 10b5-1 plans and they decide to terminate, you end up putting out the quarterly disclosure for that termination, if that termination was not by the terms of the plan, but just because they no longer wanted the plan. So let's go to the next slide. So here are some best practices. Definitely update the D&O questionnaires. What we're going to have available are updated D&O questionnaire form, which will have 10b5-1 plan disclosure questions. Definitely update your insider trading policy to capture the new 10b5-1 plan cooling off periods and other conditions. Coordinate with your insiders to timely file their Section 16 reports, and educate insiders. The reason education of insiders is so important in this context is because with this disclosure, your disclosure is only as good as the information that you receive. So in order to receive the information timely, it's important for issuers to educate those insiders that have 10b5-1 plans and put procedures in place where they're letting the company know when they've adopted them, when they've amended them, and also in addition to the usual sending the plan in for approval, to also make sure that insiders know that any sort of change and any sort of thing that they want to change, to let the company know, so we can properly get.
Okay, looks like Anthony has unfortunately frozen up here, but let's just continue on. I can continue on with the next slide, Kimberly, if you advance it. Yeah. So there is the Rule 10b5-1 plan disclosure that Anthony just talked about. In addition, there is upcoming insider trading policy disclosure that companies really just need to be cognizant of. The good news for everyone is that this really starts with the 10K for the fiscal year ending December 31st, 2024, for those companies with calendar year-end filing deadlines. And so there's a little bit of time really to review and update insider trading policies as you need to. But you will need to file those as exhibits to those 10Ks. And then in the related proxy statement for 2025, we're going to see issuers providing tabular disclosure of option awards that are close in time to the filing of 10Ks, 10Qs, or 8Ks that disclose material non-public information, as well as disclosing equity grant policies and practices for option grants and similar instruments, also starting with that 2025 proxy statement. So a little bit of time to prepare, but virtually all public companies have insider trading policies, but let's look at them, let's update them. And to the extent that you don't have an equity grant policy or an option grant policy, let's go ahead and start thinking about that too and adopting or updating it in response to this new SEC rulemaking. And, everyone, Kimberly and Anthony just went through a slew of rulemaking. For sure, the SEC has been extremely active over the past year. And so as a resource for us to just continue to keep track of all these rulemakings and how they impact our filings, we are including in an email after this presentation a one-pager that just goes filing by filing, for the next upcoming quarters and fiscal years, and where the deadlines will be for implementing these new rules. So definitely encourage you to check that out and use it as a resource going forward. But let's go ahead and start talking about risk factor and MD&A trends for this upcoming year. We live in truly unsettling times. There are rapid and unpredictable changes in the economy, the stock market, armed conflict, government policy. And so more than ever, because the MD&A is about discussing not only just financial results historically, but also, giving investors a forward look into material events and uncertainties that are reasonably likely to cause reported financial information not to be indicative of future operating results, provides a forward look. Let's go ahead and, concentrate on that this year. Are there known trends that are going to materially impact your business? And should they be disclosed in the MD&A? And with the instability in the economy, interest rates, inflation, et cetera, I do think that it's worthy to focus specifically on your company's liquidity position and capital resources. That is something that, regardless of industry, be worth your while to take a look at this season. Next slide, please. Most public companies continue to make best efforts to limit their risk factors to 15 pages or fewer, because otherwise the SEC requires a concise summary of risk factors in addition to what's already disclosed. And so, we aren't really seeing companies, with some exceptions, go beyond the 15 pages. If you do, please do include this summary. And some issuers will actually just put it as part of their forward-looking statement section, make it kind of neat and concise. The risk factors should be organized logically with appropriate subheadings. And it's an advisable practice to try to list the most material risk factors first. And of course, let's try to avoid boilerplate risk factors. So what will be new and developing for this upcoming year? Next slide, please. Artificial intelligence. Let's have conversations in our companies and see where the company is looking to apply artificial intelligence, right? Whether it's algorithms for recruiting employees and hiring employees, whether it's for development of consumer insights or for other areas. For sure, there are going to be risks that are not only operational, but also could be regulatory. So we will want to spend some time sussing out those risks and articulating them in the risk factor. For cybersecurity, the SEC has made clear that companies may be found liable for providing false reassurance or for presenting risks as hypothetical when in fact a material breach has actually occurred. So we'll want to ask some hard questions about, hey, what has actually occurred in the company? And is it material? Are we offering unnecessarily rosy language around our cybersecurity programs and practices? Is COVID still a risk? Okay, the public health emergency was declared finished in May of 2023, but the transition to post-pandemic work policies and supply chain disruptions will have continuing impact on productivity in ways that are right now a little hard to predict. So I don't think that this is necessarily a dead issue. And of course, there may be future public health threats as well. But even with COVID-19, it continues to have lasting impact that should be considered for the risk factors. And climate change, that in itself could be multiple CLEs, but there is an increasingly complex compliance environment here, and it includes compliance with California and EU legislation. I just want to ask Kimberly, have you seen your clients having to grapple with these regulatory trends?
Oh, yes, absolutely. They are having to budget for greater amounts to be able to deal with them. The SEC rules, particularly on climate change, are causing some people a certain amount of angst. As we'll discuss with California, I think everyone is assuming that that one's going to get pushed off for a bit. But one of the things that always interests me is the return to work, because you meet one of your friends, like, hey, what's your return to work policy? Which goes to things like capital resources. And does it create any issues of, are you concerned that your return to work policies may negatively impact the worker environment so that you may have more turnover, or that you'll be unable to hire if for some reason you have one policy versus another? So it is, right now risk factors are hard, and they require sort of a bit more thought. Every company should read their entire risk factor section every year. And I know that sounds obvious, but it's easy having to focus on other things to be like, no, risks are good. It's like, take the time, read them, make sure that they actually still apply in the current post-pandemic climate change world.
Okay, yeah, thank you so much for that continuing insight. Let's move on. The list of risk factors continues. It seems like, unfortunately, the risk or the threat of government shutdown is not unusual anymore. In fact, it's becoming almost periodic. And with the changes in administration, the regulatory regimes are increasingly hard to predict and also can create very sharp pivots in what companies are expected to do to comply. And so in terms of investment of time and resources, this is an increasing risk that all of us are living with, but are we articulating it in our 10Ks? Inflation and interest rates. These were risks from last year. They continue on, and they are having significant impact on our costs of operations, our raw material costs, fuel, transportation, and labor. The interest rates can also increase the cost of capital, so something else to keep in mind. Unfortunately, this past year, we've had a series of bank failures that were very disruptive to the economy and to markets. And so for the now non-banks out there, are there liquidity risks or risks for uninsured deposits that should be expressed in the risk factor section? And for our colleagues who are working at banks, consider liquidity constraints, coverage for deposits, interest rate sensitivity, and regulatory proposals that may impose additional capital and other regulatory requirements. Next slide, please. The armed conflict in Russia and Ukraine was something that we had to address last year. And unfortunately, there is now an ongoing conflict as well in Israel and Palestine. And so what I would say there is that the staff issued a sample comment letter in May of 2022 addressing Russia, Belarus, and the Ukraine. And many of the themes there can actually be carried over to the current conflict in Palestine and Israel. And so to the extent that your operations are directly or indirectly exposed to those conflicts, I take another look at that comment letter and see if there is additional disclosure. The comment letter also addresses the risk of cyber attacks, by the way. So you see how some of these risk factors are interlinking, and one risk factor can impact another one. For China, in July of 2023, the staff did issue a sample comment letter encouraging companies based in or with a majority of their operations in the People's Republic to disclose any material impact that an intervention or control by the government there may have on their business. Next slide, please. Moving on to non-GAAP guidance. So the disclosure and presentation of non-GAAP financial information continues to be a top target for SEC comment and worth attention every year. In particular, they issued some guidance this year that really should have companies taking a hard look at whether and how you exclude normal recurring cash operating expenses from your profit line. Okay. This is something that is going to get increasing scrutiny. It already is getting scrutiny, but increasing scrutiny from the SEC as to whether exclusion of these normal recurring cash operating expenses is actually misleading. Okay. And just more broadly, changing the pattern of your company's revenue recognition is something that the SEC will take a harder look at. Next slide, please. It continues to be the case that misleading labeling of non-GAAP measures is not allowed. So to the extent that you're using a non-GAAP measure, but you're using a GAAP measure label for it, the SEC isn't going to like that. So, if it's non-GAAP, don't just call it, net income or revenue. You have to say it's adjusted net income. It's adjusted revenue. And just, one more reminder, hey, a non-GAAP measure can be misleading even if the adjustments are painfully reconciled and explained. And so go back to what I was saying about the exclusion of normal recurring cash operating expenses. I mean, you can try to explain it and reconcile it all you want, but the SEC may still say it's misleading. Next slide, please. Something that I think many of us have a push and pull with our clients on is when is a non-GAAP measure presented more prominently than a GAAP measure, which is not allowed. And this can happen in press releases. It can happen in our SEC filings. And here the SEC provides some new notice just to say, hey, if you're presenting a ratio where there's a non-GAAP financial measure component as a numerator or denominator, then that is non-GAAP. You're going to have to present the GAAP ratio in an equally or more prominent position. And also, when we look at our reconciliation tables, please start with the reconciliation with the non-GAAP measure as opposed to starting with the GAAP metric. Next slide. What I'll just say here is that while it's very technical, the SEC is paying attention to inline XBRL tagging of financial information, which can include shares outstanding on the cover page, pay versus performance data, et cetera. And so you want to make sure you get that right. And just be aware that they are actually taking a look at this data to see whether companies are properly classified, for example, as a WICSI or as a small reporting company. And they're looking at this data for additional purposes too that continue to expand. For example, to see whether earnings reporting is being mismanaged and misleading. So it's definitely an area that is expanding, and we want to be careful with our XBRL tagging. And now we're going to actually move on to proxy statement disclosure, and we're going to start with pay versus performance. This performance, let's face it, folks, it's exhaustive. And I continue to ask our clients, who is using this and what are they using it for? Well, that answer continues to evolve, but in the meantime, it's pretty complex stuff, and you want to make sure you get it right. And so we're into the second year now of pay versus performance disclosure. And so this year, you're going to be doing 4 versus 3 completed fiscal years. And then next year, you're going to add on the 5th fiscal year, right? So it's progressive disclosure. And so as like last year, you'll have total compensation for the CEO and the other NEOs averaged as presented in the summary compensation table. But then you're going to also present compensation actually paid with certain adjustments for pension values and equity awards as the SEC has prescribed. In addition to those compensation measures, you're also going to be presenting for financial performance measures. And that includes cumulative TSR for your company, as well as peer group TSR. And something here to remember is that if your peer group changed between last year and this year, you're going to have to explain the change. Okay, you're going to have to put in the reasons for the change and present both TSR, present TSR for both groups. You're also going to have to present net income in the pay versus performance information. And you're also going to have to present a financial performance measure that you consider to be the most important measure for your compensation program. And this is the company selected measure. But keep in mind that this can change from year to year. And so what you presented last year, yeah, it could be true for this year, but it isn't necessarily true. Okay, so that can change. Next slide, please. Like last year, you will be required to present a clear description of the relationships between pay versus performance. But as the SEC has alluded to in its comment letters, what you want to make sure is you want to make sure that the numbers that you presented in the pay versus performance table that we just discussed are consistent with what you're presenting here, either in graphics or in narrative regarding those relationships. Next slide. And like last year, you will want to include a tabular list of the most important performance measures for your executive compensation program. Next slide. The SEC did issue quite a few comment letters on pay versus performance disclosure this year. I think the consensus is that most companies are doing a good job with it, but it is complicated stuff. There are some technical requirements that perhaps companies overlooked in the first year. And so these comments were really meant to address those certain points that were overlooked. In addition to the SEC comments, next slide, please. The SEC issued a whopping 30 new compensation and disclosure interpretations with regard to pay versus performance. And just broad brush, what these CNDIs addressed were inclusion of equity awards granted prior to a spinoff or IPO, should they be included in the compensation. Treatment of various vesting conditions in valuing equity awards for compensation actually paid. Valuation techniques for determining fair value of equity awards. Disclosure of assumptions made in valuation of equity awards. Inclusion of dividends and dividend equivalents in compensation actually paid. TSR peer group selection and disclosure got quite a bit of attention, actually, so something to pay attention to. Transitional relief for smaller reporting companies and emerging growth companies, and a situation where if you have multiple CFOs in the calculation, how do you treat them? So we are running a little bit short on time, but I do want to highlight a few of the CNDIs because I do think that they'll have broader applicability across our client base. So to the extent that your company has a compensation program where there is accelerated vesting of an executive stock awards on retirement eligibility, what you want to do is you want to treat that accelerated vesting date on retirement as the vesting date for purposes of valuing the stock award for compensation actually paid, if that in fact was the sole vesting condition. Last year, I got questions from a number of clients about when is the vesting condition actually satisfied? Is it when the performance measure is achieved, or is it when certification by the compensation committee happens? I'd say generally it's when the vesting condition is considered satisfied, okay, unless the certification creates an additional substantive vesting condition, meaning that someone had to be employed through the date of certification. Next slide, please. As I mentioned, definitely pay attention to your TSR peer group this year, okay? The SEC issued an interpretation clarifying it can't be a broad-based equity index. And also there are certain situations where you don't have to explain changes within the peer group. This next slide has to do with some transitional relief issues and the multiple CFOs situation. I leave that for people to take a look at if it applies to them. But I'm going to turn it back now to Anthony to talk about updates to the NASDAQ board diversity rule.
So thank you, Kim. When it comes to NASDAQ and their board diversity rule, the most important thing is that there has been litigation initiated against NASDAQ because of this rule. That various courts have looked into it and have said, look, it's just a disclosure thing. They're not requiring anyone to have a certain diversity mix. If you don't, then it's just more of a disclosure on why. So for us, what's important this year is just to notify NASDAQ if you're posting your matrix on your website using their company event form. So they have a list of company events. You go to their website, you click it, you fill it out, but that's only if you're deciding to meet this disclosure requirement by posting your matrix on the website. And if you have questions about what matrix you should use, NASDAQ has fillable matrix forms. We put the link here, but we're going to have it in our package of materials that you can look at. Just just use that matrix if you don't want to create your own. So we can go to the next slide. And so what's important this year is that, we got to focus on that December 31st date of this year. So not only in the previous years we had to put up our board diversity matrix, but this year we actually have to have one diverse director or provide an explanation of why, and then you got the various dates and timelines of additional directors, 2025, 2026, and on. But for us, the most important thing is that December 31st date of this year for one diverse director for companies that have been listed prior to August of 2021, and those that are listed after August of 2021, you still have time. So we can go to the next slide.
All right, so we're going to very, very briefly talk about officer exculpation in Delaware, because we have a lot to get through yet, and so we'll touch on this. So the Delaware General Corporation Law. So if you are not a Delaware, if you don't work with a Delaware company, this is a great time to check your email. So with respect to Delaware, they amended the Delaware General Corporation Law to authorize to permit corporations to adopt a provision in their certificate of incorporation to eliminate or limit monetary damages of certain corporate officers. This has always long been in place for directors and has now been expanded to officers. However, as we noted, in order to amend your certificate of incorporation, you would have to get shareholder approval. So for entities that are being newly created, we are seeing as standard forms that the officer exculpation is just being automatically drafted into all of them. With respect to existing corporations, again, you would have to go and get shareholder approval for it. And keep in mind, for those of you who are looking at proxies, if you are going to amend your articles, that would trigger a preliminary proxy filing. So in terms of timing, if you're thinking about it, that would get triggered. So corporate officers that are covered, it's a very, very broad-based list. People who agree to be identified as officers, named executives, as well as a long list. So it's a fairly broad-based definition of the concept of officer. So exculpation applies to some things, claims for breach of duty of care, etc. So it's similar to the protections given to directors. It doesn't cover things like breach of a duty of loyalty, omissions or actions not in good faith, knowing violation of the law, transactions involve the receipt of any improper personal benefit, and other derivative actions. So while it's helpful, it can't be viewed as just a shield. It's not an absolute immunity or absolute limitation of liability, but it can be helpful. So generally speaking, ISS and Glass-Lewis are slightly different on this one. They'll consider stated rationale for the proposed change if you're ISS. Glass-Lewis will generally recommend against unless there's a compelling rationale and the provisions are reasonable. So it's one of those things where, generally speaking, these have been largely passing. But keep in mind, even if you don't have this in your certificate of incorporation, you can also, and you should consider on a regular basis, reviewing your indemnification agreements with your officers to ensure that even if you decide not to do something like this, that you are, in order to be able to attract and retain them, providing adequate indemnification agreements for those officers if you choose not to seek it. Now, even if you do this, you would still likely have, and we would expect that you would likely have an indemnification agreement as well. Proxy card, bylaw amendments.
Yeah, thanks, Kimberly. So from last year, nothing new here. Rule 14A19 requires universal proxy cards for contested elections. Okay, so this is going to allow shareholders to mix and match candidates from the company and dissident slates without having to attend the meetings in person. And this all makes a lot of sense. The rules are in place companies, it makes sense to amend your bylaws so that they are consistent and reflect the processes and requirements of the universal proxy. But companies are taking their time. They're doing it opportunistically in general. So recent survey showed, approximately 40% of S&P 500 companies have adopted universal proxy bylaw amendments by the end of the 2023 proxy season. And, when and if your company does decide to do this, it's a good opportunity to review and update advance notice process and director candidate eligibility and other conditions for nominees. But you don't want to interfere too much with the shareholder right to elect directors. And so putting in excessive requirements that really interfere with this right may lead to a lawsuit, as Politan Capital Management showed us. These amendments generally should be adopted on a clear day, so outside of a proxy contest. And what you'll want to do is you'll want to just incorporate the requirements into the bylaws, because otherwise you do have to make some fairly simple disclosure in your proxy about these requirements. And just a quick reminder here that there is a default 60-day deadline for use of universal proxy notice before the annual meeting, but the advance notice deadline trumps that. Next slide, please. The SEC did provide some limited additional guidance on universal proxy this year, and they specifically addressed situations where there may be some confusing voting that's being used on those cards. So to the extent that a shareholder overvotes for more candidates than available board seats, then really that proxy is thrown out, because it just can't be voted in accordance with the specifications. Where a shareholder undervotes for fewer candidates than available board seats, then the shares will be honored with regard to the shareholder specifications, but then whoever solicited the proxy, whether it's the dissident or the company, can't rely on their discretionary authority to fill in and vote for the remaining director seats. And it continues to be the case that if a shareholder signs the proxy card but does not mark it, okay, then the soliciting party that received the proxy card can use its discretionary authority to vote for the candidates of its choice. I'm going to turn it back over to you, Kimberly.
All right, so we're going to briefly talk about climate change and just sort of wrap things up here. So I really like this picture, which is why I always start with it, because it's a very easy way to get a reminder again of what is scope 1, scope 2, and scope 3. Scope 1, your company's facility, company vehicles. Scope 2 is, the fuel, you're purchasing electricity, steam, heating, and cooling for your own use. So those are actually relatively, I'm not going to say easy, but they're more understandable. And then you have scope 3. Scope 3 is everything else, covering upstream and downstream activities. End of life treatment for sold products, employee commuting, business travel. So it's very, very broad based, which is why scope 3 is the thing that I think causes most angst, because it's hardest to measure and it's hardest to get right. So California, in October, they enacted 2 climate disclosure bills, 253, which is the Climate Corporate Data Accountability Act, and 261, the Climate Related Financial Risk Act. They both apply to public and private corporations that do business in the state of California. So if you don't touch California, and you have to think about that carefully, if you don't touch the state of California, they don't really define it, then you wouldn't have to deal with this. But because California, I think it's 15% of the GDP, a lot of people a lot of people do business in the state of California. So 253, which is the Corporate Data Accountability Act, does not contemplate consolidated reporting. 261, which is the financial risk, does. 261, again, is self-executing. It doesn't require additional regulations. 253 does. So they have some slight differences between them, including who they apply to, which we'll get to in a second. So legal challenges are expected. Even when this was signed in, the governor noted that, well, they're expecting legal challenges. Some of this may not be feasible. So I think everyone is expecting that no one is going to be complying with these for a while, and probably not in this context. So in other words, keep them in mind, but I would not lose sleep, if you understand what I'm saying. So let's quickly go through them. 261 applies to public or private corporations, partnerships, LLCs, et cetera, with annual revenues in excess of $500 million. You also have to do business in the state of California. Public reporting on your website, it's not an SEC requirement, et cetera. You have to be on a website of a financial risk report. It has to be done in accordance with the framework of the TCFD, as well as, and then reporting under the International Financial Reporting Standards, Sustainability Disclosure Standards, as issued by the International Sustainability Standards Board, will also satisfy these reporting obligations. Compliance period is going to be, the first report will be by January 1, 2026, which apparently, which I hadn't realized is a holiday, but apparently that is a reporting date, and biennial reporting thereafter. Again, we'll see what ultimately happens with these. The other one, 253. It applies again to US, and remember, these have to be US public and private corporations. So if you are a foreign entity, let's say you're a Canadian company, Mexican company, et cetera, these won't apply to you. US public or private corporations, LLCs, et cetera, they have to have annual revenues in excess of $1 billion and do business in California. So, and then it requires reporting. Remember all those scopes we talked about, scope 1, 2, and 3. And because it requires all of them, this one is hard to manage. It has to be in compliance with the greenhouse gas protocols. So these are standards that people have, they're probably closer to industry standard. Compliance time period, scope 1 and scope 2 will begin in 2026 with 2025 data. There will be attestation levels, and then scope 3 begins in 2027 with 2026 data with limited reassurances. Again, we'll see how much of this actually occurs on this time frame. Okay, I think everybody is, so we're going to kind of skip ahead to the next slide, which is really SEC update. So remember, in March, the SEC releases proposed rules, thousands of comment letters, complex, thoughtful comment letters, because this is very, very hard stuff. So in September, SEC Chair Gensler met with the Senate Banking Committee. He said, look, we're not going to give you a time frame for adoption of the rule. They're focusing on scope 3. Remember, scope 3 is the one that's really hard. And they said, we're trying to figure out how this can be addressed in the rules. And he set his staff to ensure that only public companies are regulated and not to pull private companies into it. So when you think about it, that makes scope 3 very hard to do, because if only public companies are in it, you can't ask for your private company suppliers to give you their, scope 1 and scope 2. You can't, it's hard to aggregate these things. So if you're going to limit it to public companies, which I admire, because remember conflict minerals, that pulled everybody. But if it's only public companies, then that's going to be harder to do. Now, they just issued their Reg Flux agenda. Climate change rules are anticipated in April. Please understand that doesn't actually mean what it says. It's simply a matter of their priorities. Everything is listed for either in the future or April or October, typically. They're listed in April. This is a priority for the staff. That does not mean that April is going to come and we're going to get these. So we're going to quickly skip ahead. These are in the documents. So just want to make sure that you realize, because this is new, if you are a resource extraction issuer, oil, gas, mining, in December 2020, they again adopted rules implementing some rules that were originally adopted in 2016. Essentially, it requires disclosure of payments by the issuer to the US federal government. It's simpler than the old rules. It is furnished, not filed, with the SEC, which also limits liability. The rules were effective 2 years ago. Long transition time. Keep in mind, if you have a March 31 year end, your first report is due the day after Christmas this year. So if you are a mining company, oil and gas company, or other extractive issuer, and you have a March 31 year end, if you have not already done this, this is something that you need to think about rapidly. Disclosure can be satisfied using some alternative reporting regimes. We are doing an upcoming webinar on January 10th to go through this reporting because we're only just touching on it here. We're not doing it in detail. And it's now, we ran over by a minute. We very, very much appreciate your time and attention. We know you are very busy. And if you have any questions at all, please feel free to contact any of us or your normal Dorsey contact. And we wish you a very, very happy holiday season. And thank you very much.
Happy holidays, Kimberly and Anthony. Happy holidays, everyone.
Holidays. Take care.